Welcome to How Do They Afford That, the podcast that peeks into the financial lives of everyday Australians. I'm Michael Thompson. I'm a writer and the co-host of the podcast Fear and Greed Business News. As always, I'm with Canna Campbell, financial planner and founder of Sugar Mama TV, the financial literacy platform covering YouTube and podcasts and Instagram, books, threads, TikTok and more. Hello, Canna.
Good morning. I'm so excited about today's episode because we're talking about my favourite asset class, shares.
This is you are very excited. You've been excited since the moment we walked in. And you know what? I love it. I love it when we have guests joining us in the studio because it means that I always learn something new. Which actually, as I say that now, makes it sound as though I don't learn something from you when it's just you and me in the studio. But okay, I'm going to dig myself out of this one. But when we have a guest, I feel like we can both learn on those occasions.
See, I feel like I'm in great company right now.
Yeah.
So I have someone in the room who's on the same page as me and is equally as passionate about educating and inspiring everyday people with the power of Australian shares.
God, you are excited today, aren't you? Today is going to be a cracker because we are talking about investing. As you say, we are talking about shares. We're talking about how you need to think as an investor, and we're talking about what to look for in a company when you are considering investing. Now, for many people, for a lot of people, this is, I would say, a little bit of a mystery. A lot of this. It feels, until you're in there and doing it, it can all feel a little bit kind of opaque. But today we are going to try and break through all of that. And we have a very special guest who does this every single day, so knows it better than anybody. Roger Montgomery is the founder of Montgomery Investment Management. He has more than 3 decades of experience in funds management and related activities, including equities analysis and stockbroking. He is the author as well of the best-selling investment book Value Able and is a supporter of this podcast. Roger Montgomery, welcome to How Do They Afford That?
Great to be with you. Thank you for having me on the program.
Now, before we get too far down the track, as you're listening, please know that everything that we talk about is always general in nature and never personal investment, strategic or product advice. It is purely for financial education purposes only.
Absolutely. In particular, we're talking about obviously high risk, long-term asset classes such as shares here. So always get professional advice from a licensed financial planner when it comes to making your own investment decisions.
Now, Canna, you are barely able to sit still.
No,
would you like to
I just want to launch.
Shall I just take a step back and you just jump straight in here?
Okay, the first question I want to ask you is about mindset. I'm obsessed with mindset. It's to the point where I've actually just employed a mindset coach in my life. But how does an investor's mindset work and how important is it to have this?
Well, let's take a step back from that because what we need to do is we need to understand or we need to accept how we're going to approach the stock market first. Okay. Then we can apply the right mindset to it.
Okay.
But before we do that, what we need to ask is, how do I see the stock market? How do I treat the stock market? And I think there's 2 paths towards the stock market. One is ultimately very, very profitable and it's going to be richly rewarding. And the other one, it's going to be hit and miss. You might do well, you might not. What most people do, and what I have seen a lot over the years, is people approaching the stock market a little bit like they might approach a casino or a horse race. So instead of thinking about shares as pieces of businesses, what they do is they see shares as something on a screen that wiggles up and down. You try and bet on the ups and avoid the betting on the downs. It's a little bit akin to roulette. You bet on red or bet on black and try and avoid the other colour. And that's not investing, that's speculating. If you think of the stock market as a venue where you can buy pieces of businesses, remembering that the Rich 200 list that comes out every year is full of people who run businesses. You know, there's no one in there that became a billionaire because they put money in the bank and kept it on term deposit, right? They all own businesses of some description. So businesses are a way to create wealth, one, to create potentially a lot of wealth and to do it potentially very quickly as well. So if you approach the stock market as a venue where you can buy a piece of those businesses, you're approaching the stock market the right way. And then we layer on that the right mindset.
So talk me through mindset, because this is what helps someone make great decisions for their long-term benefit and not get caught up in the noise?
Okay, so there's a couple of things. Number one, you need to think about framing your time frame. So thinking about time. Now, there's a common phrase, and you would have heard it many times. It's not time in the market. It's not timing the market. It's time in the market. That's actually 100% wrong, because the longer you spend in a bad business, the worse it's going to be. So time is only your friend if you're in an extraordinary business. So the first thing that we have to do in our minds is accept that we don't need to know everything. We don't need to know the ins and outs of every business, and when I look at a report from a research analyst on a sell side, or what's called we call it the sell side. I'm on the buy side. I'm buying for a fund, and then there are sell side analysts, and they work for stockbrokers. When I look at a sell side analyst's report, sometimes they're incredibly complex, and I think, do I really need to know all this? So in terms of mindset, you need to accept that you don't need a stratospheric IQ. You don't need to know the internal machinations of every single type of business in the world. And you don't need any inside information. Anyone can do this. If you accept that, along with the idea that you've got plenty of time, and most of the people who are listening to me speak now have more time than I do to do this, the longer the runway you've got to allow compounding to work, the better off you'll be. So if you're patient and you approach the market consistently, and we're going to get into the detail of how to do that, then you'll do very well, even if you're not a Mensa genius.
What about all the hype and the noise? How do you kind of shut that out?
Because that's easy.
Is it? You just don't pay attention. Is it because like media speculation, a lot of the hype and the drama and all of that? And I know that I'm kind of guilty of that, being kind of working in the media and kind of loving the theatre of it all. Do investors just need to shut that out and make their own independent decisions?
I think if you can turn off your phone, and I mean, you don't want to hear this, do you?
No,
if you can turn the media off, if you can turn the media off, and when I'm very specific about which media to turn off, the stuff at the end of the day that says XYZ went up 15% and ABC went down 5% and gold did this and the Aussie dollar did that, that's next to useless. We know the price of everything. That's freely available. What we've got to learn is what things are how they're valued, what they're really worth, rather than thinking about prices, because that's an information-free zone, that end of day report that says gold went up, oil went down. I actually don't know why we need to know what gold and oil did, because gold is not an investment that's going to produce any income for you. It's not something that's going to compound. Gold, for example, and this is just giving you the insights of my experience, gold is a bet on other people's fear. It goes up when people are afraid of something, and it goes down when people are less afraid. So gold is not a really great long-term investment. And I expect in 100 years it'll trade about where it is today. And that'll be about it. So it's not going to do you great. So I don't know why we follow that stuff. I don't know why we care. So turn that off. You don't need that. And that's the answer to your question about how you stop being distracted by the noise. You have to turn it off and separate yourself from it.
Can I ask you a quick question?
Of course. Ben? That's why we're here.
Yeah.
Good point. Where would you recommend that, say, a new investor access quality independent information that's not about the market's up, the market's down today, but actually gives them information that's going to add value to their situation?
Books. Books are really important. Everyone who is a successful investor is a prodigious reader. When my kids were really young, they're almost all adults now. Even the ones that are adults are almost adults. They asked me what I did for a job. And when I distilled it down, it was, I read. I do a lot of reading. Yes, there's some decisions that need to be made, but ultimately I'm reading. So the source of the best information is books, and perhaps at the end of the program I'll give you a list of them that I think are worth reading.
And I'm just going to give a very quick little plug for your website. Go to montinvest.com or rogermontgomery.com because, you are reading a lot. but you are then on those sites, you are kind of distilling the key points that people need to know. And I have used these resources, particularly kind of when we're working on fear and greed, and it is just really handy to get these insights. And you want to kind of shut out the noise. You've kind of done it for us by heading. If you go there, you can kind of get that knowledge without needing to sift through all the other stuff.
Like you guys, I've been long passionate about educating investors so that they don't repeat the mistakes of the past. You know, it really saddens me that a lot of finfluencers, you know, on social media are promoting technical analysis and charting. We've done so much work when I was at BT Australia and Merrill Lynch. We did so much research about that. You know, we looked at algorithms that ran across markets and across timeframes, and it doesn't work. And yet people are really excited about it and making the same mistakes that generations before them made. So I'll recommend some books, hopefully including my own, which was written for my kids so that if I died, they would have a recipe to follow for investing successfully in the stock market.
Can I ask you a question that may come across as probably overly simple, but what is the difference between value and price?
Okay. So that's a really great question.
Yes.
And I said earlier, price is available freely to everyone. You know, there's not much information in price, but what we need to know is what something is actually worth. So I'll give you a real life example.
Yeah.
People often say, by the way, you know, if I asked you the question, what is something worth? Any asset, what's it worth? What's the typical response you hear?
What someone's willing to pay for it.
Correct, which is, I think, wrong, because that's the price. What someone's willing to pay for something is the price. And I'll give you a real life example. Back in the first tech boom, there was a company called netj.com. Now, netj.com issued the equivalent of a prospectus, a PDS. So they released to the market what it is that they would do before they listed on the stock market in the US. And I think they listed on the NASDAQ. Anyway, their shares were going to come on. You could buy the shares before the IPO at about 50 cents a piece. They said this, and I'm quoting from their PDS or their equivalent in the US. NetJ.com conducts no substantial business activity of any description, and NetJ.com has no plans of conducting any substantial business activity of any description for the foreseeable future. Now, it's a remarkably consistent business model. It's never done anything. It's not doing anything today, and it's not going to do anything. Anyway, you could buy shares at 50 cents each. It was oversubscribed. It listed at $2. It promptly went to $8.88 at the peak of the internet boom in early 2000. And then it fell to zero and was subsequently delisted. And true to label, it never conducted any business activity of any description. Now, someone was willing to pay $8.88 a share. Was it worth $8.88? Was it worth $2? Was it worth 50 cents? No, it was worth nothing. It was worth zero because it was never going to do anything. So it was worth the cash in the bank, but of course that was being eroded by management fees and directors' fees. And so ultimately it was worth zero, and the price ultimately went to what it was worth. But there was a big gap at one point in time between the price and the value. So price is what you pay, but value is what you receive. And your job as an investor is to pay a lower price than the value you receive. And, you know, you go to auctions, if you ever go to an auction with your parents, you know, they'll stand there with their arms folded, watching the hammer go down on a property, and it'll sell for X millions of dollars. And they immediately say, oh, it's not worth that. It's not worth that. So there's an intuitive, we intuitively know that things are priced higher than what they're really worth. You know, we won't buy blueberries when they're $9 a punnet. They're not worth that to us. Now, there's an element of value that is in the eye of the beholder. You know, what something is worth to me might be worth something else to you. For example, if I'm a passive shareholder in a business, I own 1,000 shares of a company, I can't really influence what that business does. I'm literally standing on the sidelines, so to speak. And I'm at the mercy of the directors and the board to do the right thing in that business. But for another company to take over that business, to cut all the costs, to make it more efficient, and then weld it to its own business, it could be worth much more to that business than it is to us. But what we have to do is consistently over time operate the same way and buy businesses when they're cheaper than what they're worth. Only extraordinary businesses, not rubbish businesses. And we'll talk about the difference in a moment, I'm sure.
All right. So how have equities performed as an asset class over the long run?
So look, if you estimate, well, we know historically, somewhere between 8 and 10% per annum since about 1987. And that's when we're looking at the total return index, which includes the reinvestment of dividends. And we could also add the franking credits. So if you're on a tax rate that's lower than the company tax rate, you get an extra bit of cash when a company pays you a dividend. So if you reinvest all that, it's been about the same whether you look at the S&P 500 or whether you look at the Australian market. The only problem with that is that going forward, the number of high growth large businesses in Australia is reducing, and the number of high growth large businesses overseas is expanding. So in Australia, if you're looking for growth, and we're going to talk about why it's so important to invest in businesses that are growing, if you're looking for growth in Australia, you probably look at smaller companies, what we call the small cap index. In Australia, small capitalisation. And overseas, gosh, there are thousands of companies growing, believe it or not, at double-digit rates. Even when, with all that noisy, distracting talk about recessions and inflation and interest rates being high, there are still businesses out there growing at 15, 20, 30, 40% per annum, growing really, really fast. And you want to buy those businesses at a rational price.
Roger, this is fascinating. This is really, really interesting. What I really want to get into, though, and we'll take a quick break before we do it, you've mentioned the concept of extraordinary businesses. And so after the break, I want to get a bit of a guide from you as to how to find those that actually offer value and those that we talk about the potential for growth. How do you actually spot those ones that are growing? And in order to do so, cutting out the noise, cutting out everything that everyone else is saying, and to be able to do that for yourself.
I'll make it super easy too.
Perfect. We'll do that straight after the break. Hannah, we're talking about investing in shares today. We are getting a bit of a masterclass, I think you would describe it. We're joined in the studio by Roger Montgomery, the founder of Montgomery Investment Management, the author of the best-selling investment book, Value Able. Head along as well, I mentioned this before, to montinvest.com and rogermontgomery.com to hear more of Roger's insights into a whole bunch of different topics and companies and things. Roger, we've talked about mindset. We've talked about kind of some of the broad kind of concepts here about kind of buying businesses, not trading stocks, and about the need to look at value instead of price. And the fact that I thought this was really interesting when he said you don't need to know everything. You don't need to know absolutely everything that everyone is saying about a particular company or what's happening in the market more broadly. But how then do you pick companies? If you're not trying to look at everything and assess everything, how do you zero in on those opportunities?
Okay, so now we get really serious.
Yeah.
So you don't have to know everything, but you do need to know some things.
Okay.
Now, let me describe a business opportunity, and then you tell me whether you think it's a good one or not. Okay? So what we're going to do is we're going to put $1 million of our own money into this venture, and we're going to borrow another $1 million. So in total, there's capital of $2 million in this particular business venture. Okay. Now, in our first year, we make $500,000 profit. Now, that's a 50% return on the money we put in on our capital, which is phenomenal. Let's now fast forward 10 years. We're now making $100,000 profit. Is that good or bad? We were making $500,000 when we kicked it off. We're now making $100,000.
Well, one would say that was bad.
I agree. It's absolutely not good. We're not growing. We're going backwards. What if I then layered on some other information? What if I told you in the intervening 10 years, remembering the profit has fallen from $500,000, which was a 50% return, to $100,000. What if I then told you we also injected another $2 million into the business of our own money in the intervening 10 years, and we also borrowed another $5 million to keep the business venture going, and now we're only making $100,000? Is that good or bad?
I'm feeling really rather sick right now thinking about these numbers.
Can I just tell you, that's all you need to know to differentiate between a good business and a bad business. And all that information is available in the annual reports of the company. So you don't need to know much else. You need to know how to turn the stock market off, turn it off. Don't worry about the share price. We're not talking about that yet. We're not even going to look at it. All we're doing is we're going to get an annual report from 10 years ago. We're going to have a look at how much equity is being contributed by shareholders. We're going to have a look at what the debt is. And then what we're going to do is we're going to fast forward to last year, for example, and from 10 years ago, and we're going to have a look at the profit change over that time, the change in the equity, how much extra capital has been put in, and how much extra debt has been put in or paid off. That will help us understand whether the business is a quality business or not. It really is that in its essence, that's what we're looking at. Now, there's a few other tweaks and a few other bells and whistles. We're trying to find businesses that can generate. Remember earlier I said in that first year we put in $1 million and then we generated a profit of 500,000. So that was a 50% return. That return is called return on equity. What we want to do when finding extraordinary businesses is uncover those businesses that can generate 20, 30, 40, 50% every year for a long period of time. A business that can do that has something called a sustainable competitive advantage. Because as I was taught when I was at university, was that the way business works, the way the economy works, is if someone is, or a business is generating an outsized return, they're generating a really, really attractive return, it's going to attract competition. Other businesses will join that business and compete for that 50% return. And the easiest thing for them to do is to cut prices. And by cutting prices, they then reduce the return on equity. So what I was taught at university is over time, in any industry where there's an outsized return, it eventually normalizes, it reverts to the average because competitors come in. So if you can find a business that doesn't conform to that idea, its ROE doesn't fall back, but it stays high for years and years and years and years, then you've got a special business, because other businesses have tried to compete with it and haven't been successful at doing that. You know, an example of that in Australia is Bunnings. You know, Bunnings has an amazing return on equity. What does it do that's so special? Really hard to replicate. You know, for example, it has that special offer. If you can find it anywhere else, we'll beat it by 10%. How do they do that? The SKUs that they have, their products are exclusively made for them. You can't find that product anywhere else. It doesn't exist anywhere else. There's a different version of it somewhere else, but it's not the same. And so people think they're going in getting a bargain, but it's a special product made just for Bunnings, and Bunnings gets a special margin on it.
Being tricked.
Well, welcome to business. Right?
And also no one goes to Bunnings and buys one thing.
No, that's right. You know, you go there for a paintbrush and you come back with a new chainsaw.
Bunnings is obviously a larger kind of business. You mentioned before that the opportunities in Australia to find these larger companies that are growing are becoming rarer.
Correct.
So then are you seeing more of these opportunities in these smaller companies?
Yes, we are.
Yep.
You know, and just before I go there, you know, an example of a really, really challenging business, a real life challenging business that has similar economics to the ones I described with that hypothetical example, and that is Qantas, you know, airlines. So airlines have a really tough time making money, and that's because it's incredibly expensive to replace old planes with new planes.
Yeah.
And so, you know, the last CEO of Qantas didn't really buy any planes. The joke in the industry amongst pilots at Qantas was that, you know, the CEO was one of the first in the airline industry to have never bought a plane. It was just a running gag. I'm not sure if factually that's precise, but, you know, didn't buy many planes. The new CEO is going to have to replace the fleet, which is one of the oldest in the world, is going to have to replace those planes, and that's going to be super expensive. So any profits that might have appeared over the last 10 or 15 years are going to be soaked up by new planes over the next. Owning a building in the city, owning a CBD office tower, that has bad economics. Why? Because it only has a little bit of land, which appreciates. Land goes up, but buildings depreciate. Buildings go down in value. So if you owned a building in the city for 50 years, pretty much all the income that you've ever earned from the rent has to go back into updating the building to keep it competitive, to keep it attractive, because every time a new building goes up, everyone wants to move into the new flash building with all the new technology. They want to move out of the old building with the old windows and no balcony and, no tech. And so there are good businesses and bad businesses, and we now know how to identify the difference. Oh, and in answer to your question, small businesses? Well, you do the same thing amongst small businesses. Companies like Levisa in Australia, which is the fashion jewelry chain, growing really, really quickly, really cheap to set up a store, and their customers aren't sensitive to interest rates because often they're living at home, they have a job, so they've got income, but they don't have a mortgage. So if interest rates go up, it's no skin off their nose, and the price point is really, really attractive. You've got a business like ARB, for example. ARB is the aftermarket four-wheel drive parts and accessories. They're expanding. They've got a great reputation in Australia, and now they're leveraging that reputation to expand overseas. And as their reputation grows, they'll bring more cash home. And with the Australian dollar so weak, it's worth a lot more. And then you might have, give you one more example, business in the cloud computing space, a company called Macquarie Technology. They own data centers, and data centers are particularly attractive businesses at the moment because while they cost a lot to set up, once they're fully tenanted, it's just money for jam. They're just throwing off rent.
One more question on small companies before. I know, Canny, you're just itching to...
I am literally, this is like torture for me because I'm like,
so
I have
sorry.
about 500,000 questions to ask you, but I can't because we only have a certain amount
And
of
also
time.
because I keep jumping in and asking questions. What about newer companies? Because we're talking before in the hypothetical about kind of looking at, say, over 10 years. How important is a track record, and how long a track record should you be looking for in order to make this kind of educated decision?
The temptation is to buy the new thing. We're recording this, and I know this is going global, but we're recording this in Sydney. One of the toughest businesses in Sydney to run is a restaurant or a bar because Sydney-siders love the new thing. They go on to, they get really excited about something, then they move on.
Yep.
And in investing, it's tempting to go with the shiny new thing, the promotion of a new technology, for example, that doesn't have a track record. Let me say this, you can do just fine. In fact, you'll do exceptionally well just ignoring those, just not investing in those because they don't have a track record, and instead focusing on businesses that do. Now, sometimes there are businesses that are new to the stock market. They've just IPO'd, they've just had their initial public offering, but they're an older business. They've been around a long time. It's just that they haven't been listed before. That is a different proposition because that is a business where you can look at the track record. You can see what they've been doing in the past. It's just that they're new to the stock market. Technology, by the way, is a really dangerous field to invest in. Okay. Because it's really, really hard to predict who the winner is going to be. You look at the car, the vehicle, the motor car, right? I sound really old calling it the motor car because in my mind, I've just gone back to 1888, right? When the first motor vehicle, the first horseless carriage,
the automobiles.
The automobile was invented by Carl Benz. Now, here's a really interesting fact. He invented that for what was called promenading. So promenading is something you did in the late 1800s in Germany and in France. People walked around with their parasols and their dresses, and they walked around the park and they showed off their new clothes. And some of them rode horses. And then Carl Benz thought, I'm going to top everyone. I'm going to have an automobile. That's what I'm going to do. Now, here's a really interesting fact about transportation. His wife, Betty, his wife stole the car and she drove to another town. Halfway along that road, she ran out of fuel. It ran on alcohol. So she went into a pharmacist and asked for some alcohol, and the pharmacist gave her a tiny little jar of alcohol. This is all a true story. She said, no, I want all of your alcohol. She put it in the vehicle, drove to another town, did her grocery shopping or did whatever it is she wanted to do, and came back, and it transformed the world. Now, how exciting would it have been to be there looking at this vehicle and thinking, I want to invest in this. I want to buy into this new technology. Well, in the United States, since then, there's been about 1,500 car manufacturers, and there is not one today that is profitable that wasn't bailed out by government or private equity. The rest have gone broke. The same with airlines, the same with television manufacturing. Technology is great for consumers. It's usually pretty dangerous for investors.
I'm lost for words, but I do have a question.
I was going to say, I'm sensing an opportunity here for me to jump back in. Go for it, Canna.
All right. For the listeners that are thinking, wow, this is fascinating. I want to invest like this, but I'm time poor. I don't have time to go and look at an annual report from 10 years ago. Is there a cheat sheet?
There used to be. We many years ago, I developed a piece of software that allowed you to press a button and it would take all of the companies with their updated results from their half-yearly results and their annual returns or annual reports, and then it would distill all that information and then grade companies. I sold that business many years ago because I couldn't continue to run that and run my funds management business and dedicate myself to the returns for our investors. So I sold that business. That business then non-sold it again, and unfortunately the subsequent business that bought it went bust. And so that software is now gone. So the short answer is there isn't a short... There are lots of broking websites that allow you to search for companies with high rates of return on equity. Okay. So you can run a filter. You can find businesses with high rates of return on equity. Then what you need to do is go look at the ones with great returns on equity and do that analysis that we talked about earlier. And then from that list, start thinking about, and this is the hard bit of investing, it's the only hard bit, imagining how this business is going to continue winning. Why do I think this is going to be the winning business? Why do I think people will cross the street, even though there might be a cheaper product on this side of the street? Why will they cross the street and pay a higher price from this business? Tiffany's is an example, right? Tiffany's diamonds, super expensive. But I have bought all of the diamonds for my wife that I've ever bought, be it the engagement ring or a tennis bracelet or whatever. I have bought those things from a diamond merchant, because instead of paying $70,000 for a tennis bracelet at Tiffany's, I've got exactly the same diamonds of the same cut, the same clarity, the same quality. Everything's the same, and I got it for less than $10,000. Now, why do people cross the road to spend more for Tiffany's? And that's because of the provenance and the history and that
little
blue,
turquoise
that
box.
little patented blue box.
Yep.
That colour's patented. No one else can use it.
Yeah.
People and look, the fact is, people know that when they get down on one knee and ask that really, really important question, will you marry me? You don't want to finish that sentence with, and look, I saved 40%. That's not a great way to finish that question. That's a passion killer. Exactly.
Having said that, I suspect there's plenty of people listening right now that want the name of your diamond merchant.
Yeah, I'm sure. Well, happy to talk to her about that and ask if that's okay. But let me just say this, Tiffany's knows that. And there's a perception that it's better quality because it's expensive. And so they generate a really attractive rate of return on equity as a consequence of being able to charge more for their product.
Can I ask you about, sorry, now I'm just jumping back in again. Sorry, Candy, you've had one question. Now it's my turn to ask three more. Can I ask you about diversification?
Sure.
And and this is kind of a broader, because we are running out of time, but I want to ask a broader kind of perspective on a portfolio.
Yes.
So how important is diversification within a portfolio? What does that look like? And does it mean that you should be looking to own 10 or 20 or 30 or more different companies within that portfolio?
I have been doing this for over 30 years. So, I know what I'm looking for. So in my portfolio, I have 6 companies, my private portfolio. But I also know I'm going to make mistakes, and I also know I'm going to miss opportunities. So what I've done is I've invested with fund managers. So I'm invested with fund managers who are doing that for me as well. So I've got my own little portfolio where I, do my own thing, but then I've invested the larger proportion of my wealth with other managers, mostly the managers who we work with, but yeah, with other managers. So they give me the diversification that I need, and I would advocate the same approach for most people who are new to doing this. As you're learning, you're going to make mistakes. It's not easy. It sounds easy, but it's not easy because there are going to be, Trump's going to do something silly, or Xi Jinping in China is going to do something silly. The market's going to get volatile. You're going to get nervous. You're probably going to react emotionally and probably do the wrong thing at the wrong time. So it's really important to have some of your money invested with fund managers, or, some people even advocate investing in ETFs. I think there are some benefits to that, but there are also some risks, particularly those thematic ETFs. We don't have time to talk about that today. But so, I'll advocate having some element of doing it yourself, because that will make you a better investor in funds as well.
Would you include listed investment companies in this, in that obviously it's very similar to an ETF, but it's a different tax structure behind it and long-term buy and hold philosophy?
Yeah, so listed investment companies are companies that are listed, and all they do is buy a portfolio of shares or buy a portfolio of assets. So when you invest in a listed investment company, you're buying shares on the stock market, but you're buying into a portfolio. Now, the thing with the listed investment companies' shares is that sometimes they trade above or below what that portfolio is worth.
Yeah, the NTA.
The NTA, the net tangible assets. So if you're buying above and selling below, well, you're going to be doing worse than the underlying portfolio. I think they're fine if you've got a really long-term mindset. And that's what we're talking about today. So there's probably a place for them. ETFs, exchange-traded funds, tend to trade at their net asset value. They trade at their NTA. So there you're getting in and out. Typically, you're buying and selling at the underlying asset value. And there are lots of them. You can invest in Bitcoin ETFs now in the US, listed on the NASDAQ. There's so many different themes that you can invest in. I think they're potentially dangerous because often there'll be a plethora of them launching just as that particular theme is at maximum popularity. And that's one of the dangers of investing. Don't invest at maximum popularity. You generally want to invest at maximum despondency.
Roger, we are unfortunately running out of time. And it does mean that you are going to have to come back and do this again.
Very happy to.
If that's all right, because there is so much more. And I feel like I robbed Canna of so many opportunities to ask questions here. And this could be our first 3-hour episode. If we just let you just
if
go.
It's any consolation, back in the early 2000s, I used to run a session for investors for the Australian Stock Exchange, and I spoke for 8 hours on this subject.
So trying to cram it into a half-hour podcast is probably asking a little bit much. We might have to do a full series, I suspect, in that case. Before we go, though, we did reference earlier, in fact, we want to know where to get more information.
Sure.
Are there the books, things that you have found useful? And also, I will mention your website again. Visit montinvest.com, rogermontgomery.com as well. What are the books, though, we should be looking at?
So I think if you can start off with anything by or about Benjamin Graham. So if you're really keen on investing yourself, direct investing in shares, start off with Ben Graham, but then you're going to graduate from Ben Graham, because Ben Graham's method in today's market is probably going to be less than effective. He had what was called the cigar butt approach to investing. The idea that you find a cigar butt in the street and it's got one puff left and you take that puff. I'm not a smoker, but presumably people have done that. And then you throw it away and you get a return from that last puff or the one that was discarded. Much better is it to invest in high quality companies and businesses with those sustainable competitive advantages we talked about earlier. Now, the author of that style of investing is Charlie Munger, who worked with Warren Buffett. So if you can read anything, the Making of an American Capitalist by Roger Lowenstein is a really good one. Snowball is another good book about Warren Buffett. The Warren Buffett Way and the Warren Buffett Portfolio by Robert Hagstrom are another two that are really good. But then I read all those books. I've got a library of books, hundreds, and I've read them all, and I was still dissatisfied. I still felt that the Buffett and Munger philosophy hadn't been distilled properly, and I wanted to leave my kids a recipe to follow that approach in in the event of my untimely demise, they're now adults. They actually don't care about shares at all. I remember one of my kids in year 11, he took up business studies and he said, Dad, can you explain profit and loss balance sheet and cash flow statements? So we sat down, we did what we did earlier. Anyway, he puts his hand on my shoulder in year 11. He said, Dad, I've chosen the wrong subject, Dad. This is not for me. So this is really anyway, I wrote a book for him in the event that he would be interested. And that's the book that I published some years ago called Valuable.
That is great. And I know, Canna, you will be very keen to. You are holding a copy in your hands right now.
I'm getting into bed tonight with this.
Good for you.
Goodness me.
Lucky Tom.
Indeed. Now, Roger, the only thing that we haven't mentioned to you is the fact that whenever we have a special guest in the studio, that it becomes their responsibility to supply us with our savings tip of the week, which is... Really?
You kind of gave us one through your diamond wholesaler.
Oh,
How about that?
That's a big saving. That's a substantial saving. But that's not my tip.
Oh, you've got another one. A bonus, a double tip.
Yeah, my tip is there's actually two parts to it. Number one, pay yourself first. So when you receive your pay from your employer, for example, or you get your first contract, if you're starting out in a business and you've got your first invoice paid, carve out some money for yourself first and put that away in a separate bank account with no access. And that's going to be your wealthing account. You're going to build your wealth by just having this account over here that you pay yourself and then survive on the rest. You know, you pay your rent, you pay your bills, you pay all those other things, pay your parents because you're so grateful that they supported you while you were growing up, and do all of those things with what remains, but don't touch that other money. That's going to build your wealth, whether it's for your first deposit for a property or, to buy property outright maybe. I don't know. But pay yourself first. And the other thing that I'll say is when your salary goes up, don't let your spending go up.
Lifestyle creep.
If you've enjoyed your life last year, the year before, and the year before that, well, you'll enjoy it just as much if you spend just as much next year and the year after. But if your salary goes up, that's more that can go in the wealthing account. That's more that you can put aside for yourself. So pay yourself first and don't let your expenses increase with your salary.
And on that note, most of Australians are about to get a tax savings, which on average is around about $150 per month. So use that $150 to start your wealthing account.
There you go.
Was it just everybody just volunteering tips here?
It's like a blind force.
This is amazing.
I told you we're on the same page here.
You awesome. Certainly are. It feels like you are on the same wavelength. Roger, this has been fantastic. Thank you so much for coming in and joining us today.
Thank you for having me on the program.
That was Roger Montgomery, founder and chief investment officer at Montgomery Investment Management, a supporter of this podcast. Visit montinvest.com for more information. Sign up for Roger's Insights at rogermontgomery.com. And don't forget to pick up a copy of his book as well, Valuable. Now remember, this is all general information only. You should seek professional advice before making investment decisions. And Canna, if we want more information from you, where do we find you?
The fastest place to get in contact with me is actually through Instagram. So shoot me through a DM there.
Excellent. And you can hear me every day with Sean Aylmer on Fear and Greed, Australia's best business podcast. Thank you very much for listening to How Do They Afford That? Remember to hit follow on the podcast. And the very best thing that you can do to help us out is to tell somebody else, to spread the word about How Do They Afford That? Next week, we are talking about Can Money Make You Happy? It is a guide to mindful spending. Feels like the kind of thing you're going to be very passionate about.
I wrote a book called Mindful Money. You better believe it.
It is one not to miss. Join us then.